Good evening. My name is Jackie Knight. Thank you for joining me for tonight's webinar. We're going to cover some diverse investments that you could participate in a self-directed retirement account. Before I get started, I do want to mention that STC is a retirement plan administrator only. So we do not provide legal, tax, or investment advice for our clients. We also don't represent or sell securities or investments of any kind. We are not a registered investment advisor. And although I will be discussing some different types of investments in this webinar, STC does not represent or endorse any investment opportunities. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to cover some basic information about self-directed retirement accounts, and then I'm going to cover some basic details about short sales, foreclosures, partnering with a 1031 exchange property, tax liens, precious metals investment, investing in privately held businesses, and then I'm going to detail the services that STC offers our clients. I will open the floor for Q&A at the end of the presentation. So first, let's start with a definition. Some people do have incomplete information about self-directed retirement plans. When we use that terminology, what we mean is that you are working with a company and have a retirement plan that permits you to choose any type of asset that is allowable by law, not simply ones that organization, that entity might be willing to hold in your retirement account. So that would include things that some folks consider non-traditional assets like real estate. In addition, self-direction means that you are going to manage your retirement plan's investments. So, for example, you are going to make the decisions that relate to those investments. If you had a piece of real estate in your retirement account, you would decide if you were going to renovate that property and then rent it, what the rental rate would be. You would determine who could be tenants. You would decide if you were going to put a new roof on. So you would make the decisions related to the investments in your account. So in that, that means that you basically have control over the investment. Now, there are a number of benefits of self-directing, and probably one of the biggest ones is that you can truly diversify the types of assets that you hold in your retirement plan. Again, real estate, you could own a mortgage, you could lend, you could have a note in your retirement account, you could invest in a private business. Again, you choose and you control those investments. If you are interested in real estate in your retirement account, you can actually increase the buying power of the dollars that you have in that account by using leverage. In other words, your retirement account can get a loan to purchase a property. That is permissible in self-directed investing. And so because of these different things, you may be able to experience a higher return on your investment. There are a number of different types of retirement plans. So a self-directed plan is not a type of plan. Again, it means that you're working with a company that permits self-direction. So the two plans I brought out onto your screen are two commonly known plans, traditional IRA and Roth IRA. The big difference between these two plans is that traditional IRA contributions, like most retirement plan contributions, are pre-tax. In other words, the year that you make that contribution, you don't pay taxes on that contribution. But when you begin taking qualified distributions from the account, then those distributions are included in your taxable income. A Roth account is different. The contributions into a Roth account are post-tax. So you do pay taxes on the contributions in the year that you put them into the account. However, the earnings, the growth of those monies, can be distributed to you tax-free once you meet the requirements of a qualified Roth distribution. So you can actually have a tax-free earning opportunity with a Roth IRA. A SEP is a Simplified Employee Pension Plan. Oh, I should go back and mention for 2022, the maximum amounts that you can contribute to a traditional IRA or a Roth IRA is $6,000 from your earned income. If you are 50 years or older, then you can add $1,000 to that, making it a $7,000 contribution. Now, a SEP, Simplified Employee Pension Plan, is sometimes used by small business owners, sometimes sole proprietors. You can make both an employer and an employee contribution. And for 2022, the maximum contribution for a SEP is $61,000. And that would be from the business that the SEP plan is on. Simple Savings Incentive Match Plan. I know of a couple of sole proprietors and a couple of partnerships that use simple plans. Again, you would want to check with your accountant to determine what type of plan might be best for you and your business if you have a business. For 2022, the maximum contribution for a simple plan is $14,000 from the earnings. And now I've brought out onto your slide 4 different types of plans, and they all say former employer. If you formerly worked and participated in a corporate, for-profit corporate company's plan, those are usually 401k plans, or a 403b, those are often used by charitable organizations or nonprofits. TSA is a tax-sheltered annuity. TSP is a thrift savings plan. If you participated in any of these plans and you no longer work at that organization, then you can move the monies out of that plan into a plan that you qualify for, say a traditional IRA. And then if you choose, you can self-direct those monies. A solo 401k plan is a newer plan, although it's now been around for quite a while. It is a 401k for a sole proprietor. So it gives those people who are in business by themselves, for themselves, a similar opportunity to save both as an employer and employee, because that's what they are. Gives some benefits. There's a possible loan provision and a Roth provision in a solo 401k that can be very beneficial to sole proprietors, small business owners. So if you are interested in a solo 401k plan, I'd be happy to give you some more information about that. And then many of you may participate in a 401k plan and are currently employed contributing to that plan. If that is the case, you will need to go to your plan administrator to determine if you're eligible to move funds from your 401k into another plan that you qualify for if you'd like to do that and try self-direction. Just one note with the solo 401k, since we are getting late in the year, if you are interested in opening a solo 401k plan in order to make contributions for 2022, you do need to have that plan set up by December 31st. So if you're interested in that, if you're a sole proprietor, please do get in touch with me as soon as possible. We're already almost halfway through October, so we'd be happy to help you get started with that. Now, I'm going to talk about some different types of investments that you may not have considered when thinking about self-directing your retirement account. So we're going to start with short sales. And let me just mention that I did do a joint webinar with Barbara Clappett of Renaissance Enterprises. She has a great deal of expertise in short sales and foreclosures, and that previously recorded webinar is on our website if you would like to listen to that in detail. I'm going to give you some general information from that webinar. So first off, a short sale is a sale of real estate in which the lender agrees to accept less than what is owed to release their lien against the property that secures the loan. So this loan could be a first lien on a home mortgage, it could be a home equity line of credit, it could be a second lien. So there are a couple of ways that you might take advantage of a short sale opportunity, and one would be to be the bank. So this would not actually be purchasing the property, but this would be making a loan to an individual who wants to do the short sale transaction. So then you as the lender would determine the terms of that loan, interest rate, how long, when you want the principal back, all of those things. So that's one opportunity with a short sale. Another is to actually own the property in your retirement account. So your retirement account goes out and purchases the short sale property. Now, the suggested short sale criteria for Ms. Clappett were these. You want to look for a property where the owner cannot make those payments on the mortgage, and the owner has no other assets to satisfy that debt. And the property value is less than the loan balance. Another qualifier would be the investor's offer is equal to or greater than an auction would provide. So there will be some research required on your part, but to help you locate some of these, you can go to the MLS listings, and you can also check out newspaper foreclosure listings, because those items might reach these criteria for a short sale. And you can also go to the pending litigation list at the courthouse in the county, the jurisdiction that you are considering property in. So lis pendens is the pending litigation list. So those are some ideas to just help you get started. And then, of course, if you need assistance or you want to do further research, you could get in touch with Ms. Clappett, or you could do that research on your own. So some ways that you could consider a short sale property in your retirement account. Now, foreclosures are a little bit different. This occurs, when the owner is in default and a notice of default has been filed in the court. So this is an official notice has been filed. Most states have a judiciary website where you can search for property that's in foreclosure, and that then is going to show the names, addresses, the amount of a debt owed on the mortgage, give you some preliminary indication if you might be interested in the short sale, in the foreclosure. Now, some folks have asked me about pre-foreclosures, and this would be when the owner is in default, but they have not received the breach letter yet from the lender, so there's not been an official notice of default filed in the court. These can be more difficult to find. Sometimes if you happen to be a real estate investor and attend real estate investing meetings, you may hear about opportunities like this, but their pre-foreclosures are more difficult to locate. Now, locating foreclosure properties, I mentioned that state judiciary website, and again, you can go to the courthouse in the area of your interest of properties and request that pending litigation of active foreclosures. You can also search newspaper ads for auctions, and they might be listed as trustee sales. And you can also go directly to auctioneer websites. So back when I last checked this in the county that I used to live in, there happened to be 25 trustee sales when I went out to look. Now, I don't know what the current market is in the real estate, but this would be a way to start investigating and researching these types of investments. Some important things to think about if you want to go this route is to determine if the state that the property is in has foreclosure law specific relating to foreclosures. Are there any restrictions on purchasers of foreclosed property? And if you are not proficient in foreclosure law in the jurisdiction that you're looking at, then you may want to consider the use of a real estate attorney, because the laws can be complex, and you will need to determine what the foreclosure process is. And a very important question is to know if the property owner has the right of redemption, and if so, what is involved in that. So those are some important things to determine as you're looking into the possibility of purchasing a foreclosure property in your retirement account. Now, REO properties are real estate that's owned by the bank. So the bank has taken back the property from the former owner, and they now own the property. You can contact local realtors who have properties listed as bank-owned, and you can also go to bank websites directly to locate their listings. And on that bank website, it will give you the agent contact information of who you contact. So again, Barbara Clappett with Renaissance Enterprises. was our expert in short sales and foreclosures, and you can look at that webinar on our website if you'd like more information. Now, I find this topic, 1031 exchange property, pretty interesting because when my husband and I sold our home, the person who purchased it did a 1031 exchange, so I learned a great deal about it firsthand. Now, 1031 exchange refers to the Internal Revenue Code, Section 1031, and what it does is it allows an owner of property to sell the property and purchase like-kind property without incurring any immediate tax liability. So it's like a reinvestment of the proceeds directly into the new property to avoid those taxes. And there can be a lot of taxes on the sale of real estate. There could be federal capital gain tax, state capital gain tax, depreciation recapture tax. I am not a tax expert, but from what I understand, those taxes can be 25 to 30%. So if you are an investor in real estate, doing a 1031 exchange might be something you would be interested in. Now, you might be thinking, well, retirement account earnings are already tax deferred. So how would this really, 1031 exchange, relate to a self-directed retirement account? Well, let me give you an example. This is co-ownership of a property and a 1031 exchange. So, for instance, let's say that you have personal funds available to invest and you have your retirement account funds. And you decide that you want to purchase property A with those two pots of money. Now, if you have done any research or know a little bit about self-direction, you may know that normally you and your retirement account cannot do transactions together. You can't personally borrow from your retirement account can't purchase something that you already own. But this is a permissible transaction if you purchase property A co-purchase it at the inception of the transaction. So it is a viable transaction, and our client services department can help you with structuring this properly. So again, let's say property A is too expensive for you to purchase with just your retirement funds, but if you co-invest with personal funds, you can purchase property A. So let's say that you do that, co-ownership at the inception of the purchase transaction. Now, you sell the property, then your personal proceeds from this investment could fund a 1031 exchange property. So let's say, for example, property A costs $500,000 and you had $300,000 in personal funds invested and $200,000 from your retirement account. When you sell property A, the proceeds would go to each of the owners in their pro rata ownership. So if you had $3,000, you owned 300 of 500ths of that property, and those funds would come to you personally and be taxable unless you did a 1031 exchange. The proceeds for the portion that your retirement fund owns would go into your retirement account, and again, they would be tax deferred. So the point here is if you don't want to pay the taxes on the proceeds of the personal portion of the sale of property A, you can do a 1031 exchange. Now, we did a joint webinar with James Brennan of Exchange Solutions Group. You can go and listen to that on a previously recorded webinar on our website and contact James if you would like more additional information and help. But I will give you some general guidelines that will give you some preliminary information. So, 1031 exchange guidelines, very important that they be followed perfectly. They're very specific requirements. So first off, you must use a qualified intermediary. So this is an independent third party who hasn't acted as the property owner's attorney or accountant or broker or an employee within the past 2 years. prior to the transaction. And the QI, qualified intermediary, is going to hold the sales proceeds from this transaction in order to avoid constructive receipt by the property owner. So in other words, your personal proceeds cannot come to you. They would need to go to this qualified intermediary who would hold them. Now, you would need to look for like kind and eligible property. So some examples of that type of property to put your proceeds into would be property that's held for trade or business use or for investments by the taxpayer. So, for example, when we sold our home, the purchaser had another rental property and they sold it to the rentor, and they took those proceeds, turned them over to a QI, and then they invested those proceeds by buying our property, which also became a rental property. So it was like kind. They sold a rental property and they purchased a rental property with the proceeds. Some things that do not qualify for 1031 exchanges: a personal residence, so it needs to be an investment property; developed lots that are held primarily for sale; a property that's going to be resold immediately after improvements; and partnership interests and stock. So your qualified intermediary is going to help you understand what types of property are eligible to be invested in. Now, you will need to avoid taxable boots. So that means all of the relinquished property sale proceeds must be used in the purchase of the replacement property. You can't take out a portion. All of it needs to go into the new property. You do have some very specific time periods that must be followed. There's an identification time period. You have 45 days to identify a property, and then you have 180 days to actually do the exchange purchase of an identified property. So you may need to find several properties that would qualify, and then within 180 days have that money turned over into the new property. Excuse me. Some other items that are recorded in that covered in that previously recorded webinar are some methods of identification and then how to set up the transaction. So if that's of interest to you, please do check that out, and you can get in touch with James Brennan. Tax liens are, I think, a very interesting type of investment that you can do in a self-directed account. First, let's define what they are. Tax liens are might be called tax certificates, and what you are doing is you are purchasing the right to collect a delinquent taxpayer's debt. So let's think about this for a moment. There are real estate property taxes on the property that people own. If they are, and generally those proceeds are used by the governing authority for, schools and roads and running the government. So they need to collect those taxes. So if a taxpayer cannot pay their taxes, then the governing authority may sell those tax certificates or tax liens to collect those taxes. In effect, they have the money to run the government. And then the person who purchased that tax lien now has the right to collect from the taxpayer. And these tax liens they can generate very high interest rates. Again, this is if someone doesn't pay their real estate taxes, then the taxing authority offers a tax certificate or a tax lien for the amount of the taxes that are due. So the investor is going to pay that amount, and then they're entitled to earn this interest. And each state, and sometimes within state, each county might have a different interest rate. The last time I checked, Florida's tax certificate rates were 16%. You earn 16% on that investment. Another thing that is interesting and very important to you as a purchaser is that they are senior loans. So that means if there is another outstanding lien on the property, your tax lien takes preference in payoff. And they are also foreclosable liens. So if the taxpayer does not pay back the amount owed with interest during the term, you can actually foreclose on this and your retirement account could own the property. So there are a couple of ways that investors can make money with a tax lien investment. They can earn that statutory interest. And let's see, the last time I checked, in the state of Maryland, those rates went from 6% to 24% based on what county the property was in. Nebraska had a very high rate, 14% interest rate. Arizona was 16%. Connecticut was 18%. So you'll just want to check around the state that you might be interested in, see what their tax lien interest rates are. And again, this lien is also protected from bankruptcy. If the owner declares bankruptcy, the lien is not forgiven in a bankruptcy. So it is still a viable debt. I did do a joint webinar with Paul Wojcicki. He's a real estate expert and educator, and there is a previously recorded webinar on our website that he talks with us about this topic, and so you can listen to that to learn more. I will mention that again, if it's foreclosable, so potentially you could be taking title to the property. Now, in purchasing a tax lien, every jurisdiction is different. They might have their own process for selling tax liens, tax certificates. So you do need to understand what that jurisdiction's procedure is. There can be bidding processes. Some jurisdictions do a lottery. Some do a round robin where the potential investors sit around and they draw a number or name, and if that person doesn't want it, then it goes to the next person. Do they want it? Does it go to the next person? So that's a round robin. So again, there are these statutory bidding requirements. So you do need to be sure that you understand what those are. You will want to go to the county treasurer's office to understand the process and what's required for doing a tax lien purchase in that jurisdiction. So let me just talk a little bit about the process. Again, different requirements and procedures for different jurisdictions, but in general, most will require proof of funds before you can put in a bid. So we can, if you have your account with us and you're interested in this type of transaction, we can prepare a letter, a proof of funds letter that is emailed to you, the client, and that has an attachment that you can print or forward it as needed. And we can put the dollar amount that you tell us to in this proof of funds letter up to the value of your account at the time. So if you've got $500,000 in your account, but you're going to a tax lien, you may not want them to know that you have $500,000 in your account. So you can tell us up to $500,000 what you want that proof of funds letter to say. Deposits, we can issue a deposit check as you request. We have a form that you would fill out, and you would give our client services department, along with that form, a copy of the advertisement for the tax sale. And sometimes ACHs are required. So in that case, if the payment must be deducted from an account, then we can transfer funds into a special account for this purpose. And it's really a zero balance account. We would move money in, you would use that money. Money that wasn't used would go back into your retirement account. So it's going to end up with a zero balance. And we can help you sort out those details. As a client services department is great at helping people with these kinds of things, the nuances that are different in different jurisdictions. So know your jurisdiction's requirements, And do remember that the purchase must be made in the name of your retirement account, which would be an IRA LLC name with FTC. Can't do it personally, or then it becomes a personal purchase. Precious metal investing is picking up. I'm hearing that more people are interested in that these days. There's some volatility in the marketplace, and people are interested in this again. So initially, only gold and silver U.S. American Eagle coins were allowed, but in 1998, there was new legislation, and now we have gold, silver, platinum, and palladium bullion. Has to meet certain fineness standards. Collectibles are not permitted, so no collectible coins, nothing like that. There are some coins that are permitted though, so let me tell you a little bit about what FTC accepts. Gold coin and bullion, and I'll just give you a couple of examples of coins. American Eagle coins, Australian kangaroo nugget coins, Canadian maple leaf coins. So you can check if with your precious metal broker to see what they offer. Also silver coin, American Eagle silver, Canadian maple leaf, platinum coin, and bullion. So we can accept all of these. And it's a very straightforward process to own precious metal in your FTC retirement account. And this is how that works. You would locate the precious metals broker dealer that you wanted to work with. You would place your order with them and receive an itemized invoice. Then you would fax or email that invoice and our transfer form, request a transfer funds form, to our client services office. And then STC will pay that invoice and receive the precious metals for your retirement account. So we would pay that invoice from the funds in your retirement account, and then the broker would deliver those precious metals to STC for safekeeping. And they are stored in a bank safe deposit box, and in our bank safe deposit box. And so this offers a secure safekeeping for your precious metal investment, but also easy access. Let me mention a couple of things. We do not have any additional storage fees for storing precious metals. So it's all inclusive in our management fees. So just keep that in mind if you are interested in that kind of investment. By the way, if you are, I do have a flyer I can send you. So just send me a note and I'd be happy to give you some more information on that. Now, we also did a joint webinar with Jim Eshelman of Strategic Investments. He is a business broker. So you can, in your retirement account, fund partial or whole ownership of a business, and then a pro rata share of the net income from that business would flow into your retirement account. Oh, pardon me. Now, I want to clarify the distinction between ownership and operation. Your retirement account is permitted to own a business as long as you are not a disqualified person to that business. But you cannot participate in the operation of that business. That would violate the prohibited person, disqualified person transaction rule. So your retirement account can own it, but you can't participate in the operation of the business. Now, when you are investing in a privately held business, when you're considering evaluating a business, you may want to consider working with a business broker with expertise. And they're going to help you evaluate the risk versus the reward of investing in a business. Strong, small, privately held companies can earn 25 to 35% for your investment. What you are purchasing is the future stream of cash flows that business is going to generate. So you can, I should go back just a moment and make another point. When you are looking for a business for sale, again, you can work with a business broker. There are also business listing websites. And some people have asked me, well, what is actually included when you're purchasing a business. So generally speaking, furniture, fixtures, and equipment, a market rate lease if we're talking about a physical business, goodwill and intangibles. Now, whether or not there's inventory included in the purchase price, that would be something subject to negotiation. So these are all things that you would need to assess when you are looking into a business. Leverage is possible in purchasing a business. In other words, the seller could finance that back to your retirement account. We would recommend that you seek competent counsel on the potential tax consequences. Generally, retirement account investments are earned tax deferred. There's no tax immediately or tax free. But in a case like this, you could encounter UBIT, which is unrelated business income tax. And also at the time of sale, there could be tax as well. So you will want to talk with your accountant if you're considering a privately held business. Another possibility is to make a loan to the business owner. So then you could determine what those terms of the loan are. Oftentimes business owners need startup working capital or they need funds for inventory purchases. So you could set the terms of the loan, the interest, it could be for a percentage interest or a percentage of profit. You would decide the term of the loan, how long. So there is another way to invest without actually owning the business or partly owning the business, and that would be through a loan. Again, I did our joint webinar with Jim Eshelman of Strategic Endeavors. So if you'd like more information, you can listen to that webinar on our website and get in touch with Jim if you like. Now, I mentioned that SEC sets up an LLC, that the name of your retirement account is an IRA LLC. And we use this type of entity for each of our clients' accounts because it has some very significant benefits for you. First off, it does offer you maximum flexibility. We have some very complex transactions that might involve leverage, multiple parties, multiple otherwise disqualified parties. Sometimes there is real estate improvement going on and there are parties to the transaction who might be benefiting from the transaction. So using this LLC structure offers a lot of flexibility and structure in these types of transactions. It does give you an additional layer of asset protection. It is a limited liability company, but it is a very specialized one. It's not a generic business LLC. Its operating agreement and its articles of incorporation are written so that it can be owned by a retirement account. It's a very specialized LLC. It does give you checkbook control over your retirement funds so that you have immediate response to investment opportunities. Now, you'll notice that I have checkbook control in quotes, and that is because we don't actually give the checkbook to our clients. And we do that really partly to protect you from possibly engaging in a prohibited transaction. The penalties for doing that can be very severe. So instead, what we do is we review your transaction and then we can same day or next business day fund that transaction if all of the paperwork is in order, if it's titled properly and structured properly. So really what you have are experts looking over the details of your transaction to make sure that it complies with the IRS rules, and then we can get the funds to the seller immediately if there's no problem. And if there is a problem, of course, we would get in touch with you and talk with you to work that out before the investment was made. Using the LLC also simplifies asset titling. A great example is if you want to purchase real estate in your retirement account. Unlike some companies where you have to send the closing documents to their office and somebody has to review them and sign off on them, with an LLC and SEC account, you can actually go to the closing on behalf of your retirement account, and you can sign the closing documents on behalf of your retirement account. So it does offer you that benefit as well. It does also make it easy to pool monies from your retirement account with other funds in order to co-own investments. Just like I was talking about that 1031 exchange investment where you had some personal funds and some retirement account funds, you can pool money and co-own an investment. So let's take a look at a schematic of an STC retirement plan structure. And up on the upper left, you see your current custodian. This is where your current account is held if you have one. And you decide that you want to work with STC, and so we are going to be setting up your account. So you would complete some documents that would direct your current custodian to transfer or roll over the funds from your current account to our self-directed custodian. While that is happening, our operations department will be working to set up the LLC in the state of your choice that is going to be owned by your retirement account. Once the monies reach our custodian and your LLC is set up, then the ownership interests of the LLC are given to the custodian. The custodian purchases those with the monies, and they move to a bank account that now your LLC has access to. So in this example, your retirement account has 3 investments. Investment number 1 is a tax lien, so you're earning statutory interest on that. Investment 2 is gold bullion, so you're hoping that's going to appreciate in value. Investment number 3, you purchased a foreclosed real estate, but you are one of 4 owners. Your retirement account does not wholly own this. And the other investors are your father, your daughter, and some of your personal money. Now, normally, your father and your daughter and you personally are disqualified persons to your retirement account. But if this is structured properly and you co-invest at the inception of the purchase transaction, then this is a viable transaction and it is permissible. So our client services department can help you structure that type of transaction. So now you can see you have some very diverse assets in your retirement plan. And of course, you could also always have a brokerage account if you wanted to do some stocks and bonds and ETFs, whatever, trading. You could also do that too. So let's talk just a little bit about STC's approach, what we offer our clients. We do offer that LLC structure set up, that protected checkbook control, our experts looking over your transaction before you invest. We do have CPAs and attorneys available to answer technical questions. We have a wonderful client services department that can give you unlimited guidance on transaction compliance. So I always suggest that people talk to them in advance of making an investment. Talk to them about what you're thinking of doing, making sure you structure it, you title it properly. They're happy to help you with that. We also handle all of the back office support that's necessary. There are administrative requirements that must be fulfilled, valuation made annually, reported to the IRS, books and records maintained. We maintain detailed financial statements. We supervise any regulatory reporting, and we oversee that annual valuation. So our whole goal is really to provide you all of the expertise on transactions and all of the backup administrative support that you need for a self-directed retirement account. And then that permits you to spend your time and focus your energies on finding really the best investments for your retirement account. So really, we would love to serve you. How can we help you? Perhaps you want to open a self-directed account now. Perhaps you have clients or colleagues who might be interested in self-direction, or perhaps you just need more information. Please check out the information here. Our website has a great deal of information for you there, even some client testimonials and some of them talking about the types of investments that they have done in their self-directed accounts. Our corporate number is there, and then my direct email. Please feel free to send me questions or request information if you have that need. Now, I am going to take a moment and open up the question box and see if we have any questions. Please do, if a question has come to your mind, please do type that in. I did get a couple in advance of the webinar, so let me pull out those papers while you type any questions in. Okay, once my account setup is complete, what does STC require from me to purchase an investment, and what is the turnaround time? Okay, once your account is set up, and I will just mention that we do ask you to give us 4 to 6 weeks to set up your account. It may not take that long, but we never know how long it's going to take from your current custodian to move the funds to our custodian. And we facilitate the processing as quickly as possible, but we also aren't in control of the states setting up the LLC documentation. So there are a few things that we cannot control. But once your setup is complete, then we simply need one of our forms called a request to transfer funds. That's the name of the form. And that will indicate the type of investment, the dollar amount, who's the seller, any appropriate backup. For instance, if it's a real estate transaction, we'll need promissory note, HUD-1, etc. And as long as all the paperwork is in order and we have it by the banks, our bank's 2 p.m. cutoff time, that's 2 p.m. Eastern, we can generate a same-day wire transfer to the seller and purchase that investment for your account. If we don't have it by 2 p.m., then it might be next business day. Okay. Okay, so this is a question related to RMD, required minimum distribution. Once you reach a certain age, and it's now 72, there are certain accounts that you must take a minimum distribution from each year. And that distribution then may be taxable, go into your taxable income. So this question is the RMD based on total assets, or cash in hand, or equity? So they must have in their account some investments, some cash, and it sounds like equity, they may have a loan on a property. So they might have a piece of real estate that has a loan on it, so they don't own it outright. So just to help you think through this, and you will want to check with your accountant specifically because they'll know the details of the investments that you own. But generally, the RMD is calculated for each account by dividing the prior December 31st balance by a life expectancy factor, and the IRS publishes that each year. If you own real estate, then the fair market value of that property will be included in the balance of the account for purposes of calculating the RMD. And if you have a loan on that, that would be deducted from the fair market value. So you will need to talk to your accountant. An evaluation, an actual valuation would need to be done of the property if you own property. And then the RMD would be calculated based on the IRS tables. If you have more than one account, the RMD is calculated on the combined balances of the account. But the distribution doesn't have to be taken pro rata from the accounts or anything like that. It can be taken from a single account if you wish. So that's just some general information. You will want to check with your accountant to determine the specifics that relate to your personal situation. Can I get a mortgage on a property for my IRA account? Yes, I did refer to that, but say a little bit more. You can, your retirement account can, but it must be a non-recourse loan. It's more like a commercial loan, and it means that the lender only has recourse to the property in case of a default. So they can't come after you personally, your personal funds, other funds in your retirement account. They have no other recourse. That's where the non-recourse terminology comes in. Generally, they will require a larger down payment, and there will be lender guidelines that you'll need to comply with. I did do a webinar with a lender that you might want to check out. That's also on our website that talks about non-recourse lending. Okay, let me just check my time. I have time for one more question. Let's see, I answered that one. Okay, if I want to put IRA money into a self-managed stock brokerage account, can I? Can I actively trade in that account with IRA funds? Yes, you can. In fact, we have clients who, when they're between investments and they have cash in their retirement account, they do like to invest it, keep it invested until they find maybe their next property or whatever. So yes, you can open a brokerage account. It can be with any company you choose. It does need to be opened as a business account, and it does, not a personal account, and it does need to be in the name of your IRA LLC. And then what we would request is that you send us copies of your monthly statements, because we need to ensure that you're not making any deposits directly or taking any withdrawals directly from that account, because it's not yours personally, it's your retirement account. So the money has to flow through your retirement account as a contribution or a distribution. So, but yes, you absolutely can, and we certainly do have clients that do that. Well, I'd like to thank you for joining me this evening. Please do let us know if we can be of service to you. You can get in touch with our corporate office or contact me via email, and please do check out our website. We do educational webinars every month, so I hope you will consider joining me next month. Thank you. Good night.